Gang, PayPal earnings are out and they are a stinker. Stock is down 16% or thereabouts pre-market after releasing their Q4 earnings, announcing that their CEO is gone, they're hiring a new guy, and giving guidance that's pretty terrible. And this has been a perennial value play. This has been one of those stocks that buys back a ton of their shares, trades at a low P ratio, and if only they could just start growing faster again, show the market that they're not a dead company, then this would be a good investment. But now the reverse is happening, unfortunately. They're actually shrinking faster than the market expected, losing market share faster than the market expected. Margins are being pressured. So does it really matter that they're buying back $6 billion in stock every single year when the stock just keeps going down and down and down? So really the stock they bought back in the last year has been overvalued. They could have bought back more if they just waited or made investments in the business rather than just throwing money away into stock that's continually shrinking. That's a bummer for investors for sure. So I don't know what the fix is here, but they're thinking Alex Chris isn't the fix since they're getting rid of him. This is a CEO they just brought in 2 years ago. They're now replacing him with the CEO of HP Inc., who has been in place there since November 2019. And in November 2019, that stock traded at $19. Now it trades at $19. So they're bringing in the best of the best if they want to keep value exactly the same. So let's look at these earnings. Net revenues up 4% to $8.7 billion. The market had this pegged at $8.8 billion. Non-GAAP EPS up 3% to $123. The market had it pegged at $128. So missing expectations quite a bit there as well. You may say, well, that's not terrible. They're still growing the top line and the bottom line, even if they're missing expectations, even if there's some non-GAAP operating margin pressure, still growing a little bit. But the main problem is the guidance they're giving for 2026, for Q1 2026, mid-single digit declines in both GAAP EPS and non-GAAP EPS. And for the full year 26, mid-single digit declines in GAAP EPS and low single digit declines to slightly positive in non-GAAP EPS. And remember, they are buying back 10%-ish of the company during this year as well as the past year. So the fact that they're still shrinking EPS, earnings per share, which is impacted by stock counts, means that the overall business is really shrinking, and without the benefit of those stock buybacks, they'd be down quite a bit more. And yes, they still have a pretty good balance sheet, $14.8 billion in cash, $11.6 billion in debt. They're still buying back a bunch of shares, repurchased 23 million shares in Q4, returned $6 billion in the 12-month period of 2025. They're going to continue to do that in 2026. They do have a dividend of 14 cents, so you do get a bit of a dividend payment. And maybe that's really what you're aiming for here. It's like, yeah, this business is slowly shrinking, maybe slowly dying, but it's going to take a while for that to happen. And they're going to be able to buy back a ton of shares while they do that. If you look at where the market cap is after this 15% reduction, it's going to be in the low 40 billion range. If you're buying back 6 billion in shares next year as well, which is what they're aiming for, that means they're going to be able to reduce their share count by 13, 14, 15%, something like that. But if that's the case, why the heck is their EPS declining quite a bit in 2026? How quickly is their business deteriorating? That's really the problem you're dealing with as an investor in PayPal. Do note that I was once an owner of PayPal, don't own it anymore. Luckily, got out before the dump off. The momentum was just terrible. I just didn't see the need to hold this company. Yes, stock buybacks are great, but whenever you're buying back stock in a company that's continually declining, that's not a good sign. And you look at the guidance they gave during Q3 for Q4 2025, 2 to 5% growth in transaction margin dollars. They saw 3% growth. Non-GAAP EPS, they were guiding for 7 to 10% growth. We actually saw 3% growth. So the business is declining even faster than they expected. There's margin pressures on this business that they didn't forecast just 3 to 4 months ago. So that's a bit concerning for future investors as well. And then as we take a deeper dive into their Q4 release, remember this is an international business, so they benefit from a weaker dollar, which we have right now. So you can see that it's 9% total payment volume growth, but on a currency neutral basis, it's about 6%. Similar issue on the revenue side, benefiting from the weaker dollar. But a lot of that isn't flowing down to transaction margin or any of these other things. At the end of the day, those numbers are deaccelerating over last year. And this is an issue that we've seen for quite some time with PayPal. Their transaction take rate has been going down, and that continues to be the case. I said that in prior PayPal videos. Until they fix that, it's hard to be interested in this business, and that continues to be an issue in Q4 and probably going forward into 26 as well. As we go down into some of these activity metrics, active accounts and monthly active accounts continue to be decent, growing a little bit. Actually, number of payment transactions went up, but I think some of these must have been in markets where they're not making as much money because the take rate keeps going down and down and down. And per active account, people are making less and less transactions as well. Then as we drive down into the TPV mix across PayPal's platforms, really this is important because it shows which parts of the business are growing and is it the parts that have higher margins. And the answer is no. Branded experiences is deaccelerating, only up 4%. Branded checkout online, which is probably one of their higher margin businesses, is only up 1% over last year. Big deacceleration there. Venmo is still growing, accelerating actually, but this is still a small part of their business. I think they have something like $1.7 billion in revenue from Venmo, so not terrible, but it's a very, very small part of their business. As you can see, the other parts of the business are kind of holding steady or even accelerating a bit, but really it's branded checkout and P2P that make up the majority of their revenue. P2P lower margin, branded checkout higher margin, and branded checkout is deaccelerating faster. And then we go back to the guidance, and this is really the crux of the problem, why this stock is being punished so much. It's the fact that the market expected probably mid to high single-digit EPS growth, mostly driven by those share buybacks, not even bottom line improvement in the business, but now they're seeing a mid-single-digit decline for both Q1 and the full year. That's a big problem, assuming those numbers include the $6 billion in share repurchases they're going to make this year and next year, because if that's the case, then the underlying business in terms of their net income growth is shrinking at a much faster clip. And if the market expected high single-digit growth for the next couple of years and was giving this company a 10x multiple, what multiple does the company deserve if it's actually shrinking? I think the answer is that the market has it priced correctly right now. You look at the guidance they're giving, let's say a 5.15 EPS for 2026 based on the low single-digit decline. Compare it to the $44 price point pre-market, gets you to about an 8.5x multiple. That seems reasonable for a company that's shrinking their bottom line a little bit in 2026. Yes, they're going to buy back shares at that level. You're potentially talking about reducing the share count by 11 to 15%, depending on where the price point sits. That's going to be very accretive to potential future EPS growth, but it's not being reflected in 2026 just yet. The question is, how do you fix that? It's not an easy question to answer. The new CEO will have his work ahead of him. Yes, buying back shares is great, but if the price point continually goes down, that's an issue. Should they be investing more in the business rather than just buying shares that continue to decline? Yes, they're investing in branded with Fastlane. They're investing in Venmo, their debit cards. They are making some acquisitions. They just made a small acquisition in the agentic commerce space with a partner there. RG3, I think, is very happy with his Venmo debit card, but that's not showing up in the results just yet. You look at their total take rate, you look at their transaction take rate. Year over year, those numbers are going down. Q3 24 to Q3 25, down 2 basis points, down 3 basis points on transaction take rate. Then you look at Q4 24 to Q4 25, down 8 basis points on both. That's a problem. Until I see this number consistently go up year over year, this is not an investment I want to be in. And that's just really the case, no matter how cheap it is. There's plenty of cheap, low PE ratio stocks out there that are buying back shares. And PayPal is just another one of those. To me right now, this is more of a value trap than a value buy. And I'm not really interested in owning PayPal with the results they're putting out right here until I see that they're improving. What do you think? Am I wrong here? Am I missing something? Comment down below, like the video. And if you're new to the channel, subscribe. And thanks for watching. Bye.